Hey everybody, let's have a look at analytical procedures again. Remember they're used at the planning stage and at the review stage, and this screen here is really just showing you how we use them at the planning stage. However, I think let's have a think about how we use analytical procedures at all stages really. So looking at this, you can see that sales have doubled in year 2, and so therefore you'd expect cost of sales to double. But cost of sales have more than doubled, and so hopefully you can see that that is probably where there's something going wrong, or there's something strange happening. You want to know why the gross margin has changed, why cost of sales increased more than sales. There may be a good reason. It might be that we're buying different products, or it might be that we've misallocated things that are in cost of sales that should be in expenses. Something strange, and that would help us focus and go and find out where. Or if we're at the review stage, we would say, right, let's have a look. Do we have the evidence to support why cost of sales had increased? Because this is what we need to know. So how do we go about doing it? Well, there's 4 stages. First of all, you formulate your expectations, which is what we did there. We realised that sales doubled, so cost of sales should double. Then you identify the variances. It more than doubled by 200. You then have to go and investigate why, and then evaluate the impact on the audit and on the audit report. So let's have a look at those in a little bit more detail. The first one then, formulate your expectations. How do you do that? Well, by comparing, like we did just now, compared to year 1, compared to the previous year accounts, compared to budgets, the industry knowledge. Do you know that things are more expensive in that particular area now? Maybe it's foreign exchange or something. Or are there any non-financial reasons as well? So you're getting all your expectations and you're expecting things to happen. Then phase 2, you do what we did and we identify the variances. You look at the previous years, etc., and you see where the variances are. Then once you know where the variances are, we have to go and investigate them. Okay, so we investigate them by looking at things like the inherent factors. Is there anything inherently risky, or is there anything inherently that means that they may go up and down? For example, share prices can go up and down according to the market, or oil prices, or gold prices, or whatever it might be. They can go up according to the market as opposed to just staying the same depending on how much you buy. The reliability of the data. Is this just based on budgets? Is this the final year accounts? How reliable is the data? How much evidence have we got? Talk to management then. Ask them to explain the differences, and once they give us the answers, then we need corroboration. We need to decide, does it all add up? Does it our knowledge of the business, our knowledge of the industry, the non-financial factors, all the other evidence that we've gained, does that all agree with what management's telling us, what the inherent factors are? Does it all seem appropriate? So do we have sufficient and appropriate evidence at the end? And then finally, you have to evaluate the impact on the accounts. Now, if there is a difference and the auditors can't explain, it's not the audit, the directors can't explain why, then you've got to think, well, they're not very in control then of their of their control systems, of their accounting. They're not on top of it. Or you're worried that they may be keeping something from you. If that's the case, you then have to go back and do more testing, particularly where you've relied on management representations maybe a little bit too much, and you have to go back and try and get more evidence. So evaluate the impacts on the accounts and audit. So try and remember that 4-stage process.